Hello students, welcome to the lecture on receivables and inventory management. And after this lecture, we will be able to learn the following objectives. Understand receivable management, define objective of receivable management, explain credit policies of receivable management, discuss evaluation of the credit applicant, describe inventory management, define techniques of inventory management, and explain economic order quantity model EOQ. Receivable management. Let us start with what management is. Management of trade credit is commonly known as management of receivables. Receivables are one of the three primary components of working capital, the other being inventory and cash. The primary aim of receivables management went in minimizing the value of the firm while maintaining a reasonable balance between risk in the form of liquidity and profitability. Objectives of management of receivables are to attain not maximum possible but optimum volume of sales, to exercise control over the cost of credit and maintain it on a minimum possible level, to keep investments at an optimum level in the form or receivables, to plan and maintain a short average collection period. Works of receivable management. Pull business credit. They will look at how business has dealt with other suppliers and vendors. Pull personal credit. They want to ensure that not just one business is willing to and has demonstrated in the past that we will repay suppliers. Pull financials. Many suppliers will look at analyze financial strengths via supplied financial statements or tax returns. Important benefits. Efficiently managed receivables can free up funds and at the same time improve customer relationship. Reduction of funding requirements and interest expenses as cash flow increases. Reduction of days receivable outstanding DSO, bad debt and receivable write-offs, improvement of liquidity and free cash flow, improvement of the customer communication and the customer relationship, optimization in all elements of the accounts receivable processes, credit policies of receivables management. A central element in developing credit management policy involves design choices on the extent to which credit activities are best managed internally or through specialist market intermediaries. A firm practicing lenient or relatively liberal credit policy, its size of receivables will be comparatively large than the firm with more rigid or signet credit policy. It is because of a lenient credit policy leads to greater defaults in payments by financially weak customers, resulting in bigger volume of receivables. A lenient credit policy encourages the financially sound customers to delay payments, again resulting in the increase in the size of receivables. Aspect of credit policy. A credit policy establishes guidelines that govern grant or reject credit to a customer, what should be the level of credit granted to a customer, etc. A credit policy can be said to have a direct effect on the volume of investment a company desires to make in receivables. Credit policy of every company is at large influenced by two conflicting objectives, irrespective of the native and type of company. They are liquidity and profitability. Variables of credit policy. The important variables of credit policy are credit standards. Credit standards refers to the minimum criteria adopted by a firm for the purpose of shortlisting its customers for extension of credit during a period of time. The quality of firm's customers largely depends upon credit standards. Analysis of customers is done under two aspects. Average collection period. It is the time taken by customers bearing credit obligation in materializing payment. Default rate. This can be expressed in terms of debt losses to the proportion of uncontrolled receivables. Collection policy. Collection policy refers to the procedures adopted by a firm creditor collect the amount from its debtors when such amount becomes due after the expiry of credit period. 5 C's of credit. All the 5 C's of credit are character. Character means reputation of debtor for honest and fair dealings. Capacity. Capacity refers to the experience of the customers and his demonstrability to operate successfully. Capital. Capital refers to the financial standing of a customer. Collateral. Collaterals are the assets that a customer readily offers to the creditor, that is, firm granting credit as a security which should be possessed by the firm in the event of non-payment by the customer. Conditions. Conditions refer to the prevailing economic and other conditions which can place their favorable or unfavorable impact on the ability of customer to pay. Evaluation of the credit applicant. The goal of modern credit management is to evaluate customers' creditworthiness as precisely as possible and provide early warning of credit defaults. This requires software solutions which provide comprehensive support for the demands and core processes of credit and receivables management. Data collection and import comprehensive and up-to-date information about a firm's customers is the fundamental precondition for successful credit management. The credit management platform. It provides data entry screens for credit managers to collect all necessary customer data such as master data, financials and credit limit requests. Risk analysis and determination of creditworthiness. Scoring models may be freely defined for the analysis of creditworthiness and limit determination. Credit and limit decisions. Any approval processes may be implemented, for example, to require the approval of a superior before changing a credit limit. Reporting and administration. All input data and output values, example, credit limits, are centrally stored and maintained in an electronic credit file. Monitoring and early warning system. The customer base can be continually monitored using freely definable business rules that define the criteria by which work list entries are generated. Simulations and impact analysis. Rule models for customer scoring and creditworthiness assessment can be simulated using historic data before they are taken into production. Process management and monitoring. The credit management process is also subject to constant process optimization in order to make the most efficient use of available resources. Risk control and management. On the basis of data, a wide variety of analysis may be performed, providing comprehensive information regarding risk distribution within the portfolio, risk concentrations, or trend analysis among other areas. Credit terms. The receivables management of an enterprise is required to determine the terms and conditions on the basis of which trade credit can be sanctioned to the customers are of vital importance for an enterprise. As the nature of the credit policy of an enterprise is decided on the basis of components of credit policy. These components include credit period, cash discount, and cash discount period. Credit terms refer to the stipulations recognized by the firms for making credit sale of the goods to its buyers. There are two important components of credit terms. Credit period. Credit period is the duration of time for which trade credit is extended. During this time, the overdue amount must be paid by the customers. Cash discount terms. The cash discount is granted by the firm to its debtors in order to induce them to make the payment earlier than the expiry of credit period allowed to them. Cash discount is expressed as a percentage of sales. Credit control. Credit control is a complex process which costs both time and administrative costs. The function of credit control incorporates the following elements: checking customers' creditworthiness, prompt invoicing and follow-up, credit insurance, financial statements, and use of electronic data processing equipment. Checking customers' creditworthiness. This step relates to applicant's ability to pay for the goods or services opted by him. Prompt invoicing and follow-up. This is an executive action involving prompt issue of invoice and equally close follow-up action. Credit insurance. This point pertains to credit exports. Financial statements. Financial statement is an important document that presents desirable sources of information to the seller regarding the financial position of customer for credit control. Use of electronic data processing equipment. Electronic data processing equipment holds its own individual importance in providing timely and accurate information pertaining to the status of accounts. Inventory management. A significant example concerning inventory management is allocation of responsibilities and authorities. Inventory control problems can easily arise when, for instance, nobody in the organization is responsible for the inventory, or the responsible person has insufficient authorities to carry out the task. Objective of inventory management. Protect the company against theft. Make sure that the only people in warehouse belong in warehouse. Establish an approved stock list for each warehouse. Order only the amount of non-stock or special order items that customer has committed to buy. Assign and use bin locations. Assign primary and surplus bin locations for every stocked item. Record all material leaving warehouse. There should be appropriate paperwork for every type of stock withdrawal. Process paperwork in a timely manner. All printed picking documents should be filled by the end of the day. Set appropriate objectives for buyers. Buyers should be judged and rewarded based on the customer service level, inventory turns, and return on investment for the product lines for which they are responsible. Ensure that stock balances are accurate and will remain accurate. Implement a comprehensive cycle counting program. Techniques of inventory management. Inventory management can be one of the most expensive aspects of running a business, but with proper techniques, we can reduce the inventory burden on bottom line. Just-in-time delivery. Just-in-time delivery, or JIT, is an inventory system that works to reduce the amount of inventory that a company will have on hand. Drop shipping. Drop shipping is an inventory process by which a company can sell a product to a consumer without ever having the product in inventory. Bulk shipments. Bulk shipping is an old staple of inventory management. The idea is that it is cheaper to purchase and ship goods in bulk, so we plan to replenish our inventory less frequently than we normally would. Record keeping. The basis for all inventory management is record keeping. Small companies may be best off keeping track of the inventory manually. Physical inventory. Physical inventory should be done at least once a year and as often as once a month, depending how likely items are to be missing. Cleaning out old inventory. Storing inventory is not free. Inventory represents an investment in a product or material. Mastering stock levels and inventory management. For dealers, Keeping controls of parts and whole goods inventory can be tricky. Inventory overload. Many dealers have excessive amounts of parts and whole goods. Money that could or should be spent elsewhere is stuck on the shelves or in the showroom. Evaluate and purge. To get that idle inventory out of the way, dealers should evaluate which parts and equipment are needed and which are in less demand. Storage and monitoring. Once inventory has been whittled down, what's left should be well organized in a manner that allows for easy operation. Economic Order Quantity Model (EOQ). Managing inventory is an important task for every business that holds it. There are many costs that occur because of inventory that need to be minimized while still providing enough inventory to operate without losing customer business. The EOQ, Economic Order Quantity Model, is used to minimize these inventory-related costs. Calculation formulas. The cost of carrying inventory can be calculated by multiplying the cost of carrying a unit of inventory C by the average number of units carried Q, usually for a year. Carrying cost is equal to C in bracket Q by 2. To determine the number of orders, we simply divide the total demand D of units per year by Q, the size of each inventory order. Number of order is equal to D by Q. To determine the ordering cost, multiply number of order by the fixed cost per order F. Ordering cost is equal to F in bracket D by Q. The total inventory cost for a year for a business is simply the sum of the carrying cost and the ordering cost. Total inventory cost is equal to C in bracket Q by 2 plus F in bracket D by Q. Using calculus to determine the minimum point where the slope equals 0 will provide us with the optimal order quantity to reduce total inventory cost over the year. This is known as the economic order quantity. EQQ is equal to 2FT upon C 1 by 2. Summary. Now in the end, let us summarize what we have learned in this lecture. Receivables are one of the three primary components of working capital, the other being inventory and cash, the other being inventory and cash. The primary aim of receivables management went in minimizing the value of the firm while maintaining a reasonable balance between risk in the form of liquidity and profitability. The main purpose of maintaining receivables is not sales maximization, not as for minimization of risk involved by way of bad debts. The goal of modern credit management is to evaluate customers' creditworthiness as precisely as possible and provide early warning of credit defaults. Inventory management can be one of the most expensive aspects of running a business, but with proper techniques, we can reduce the inventory burden on bottom line.